Good afternoon, everybody, and welcome. My name is Anne-Sophie, and I'm very excited to be leading today's discussion on behalf of Digital Euro Association. It's a pleasure to welcome all of you. And I'd like to also thank our panelists for joining us. And before we dive in, I'd like to invite each of you to briefly introduce yourselves and the perspectives you bring to this conversation. So maybe Karen, we'll start with you.
Sure. My name's Karen Otoni. I'm with Linux Foundation Decentralized Trust. We are part of the broader Linux Foundation umbrella, but we focus on hosting open source technologies in the decentralized space. So think DLTs, ledgers, cryptographic tools, smart contract technologies, decentralized identity, etc. And many of the implementations you're seeing by enterprises and institutions use our technologies. And I look forward to talking more about that as well. I've been in this space since 2016, primarily focused on ecosystem building in amongst the enterprise industries for them to leverage the use of these sorts of technologies. Thank you for having me.
Thank you, Karen. Georg, over to you.
Yeah, hi, Georg Schneider here. I'm currently responsible for RWAs globally for Canton Network. So I work at Digital Asset. We're the creator of the technology behind the Canton Network. Canton Network is a layer one with institutional grade privacy, and we're really on a mission to make finance work the way it's supposed to work using this technology. And have built over the past 10 years features that make this really ready for institutional use cases at scale, working with some of the large global FMIs and banks to really bring these new rails into traditional finance. My personal background is in equity derivatives, worked for 10 years there and saw the complexity that we're now trying to solve. And so, yeah, happy to be here.
Thank you, Georg. David, your turn.
Do you hear me well?
Yes, we can hear you.
Super, thank you. Donc, hello, David Durochaud. I'm the CEO of Société Générale Forge, which is a regulated subsidiary of Société Générale Group. We are dedicated to digital assets. We started in 2018 by tokenizing financial instruments. We did some project as well with digital euro for wholesale markets. And since 2023, we are issuer of stablecoins and providing a set of services around crypto. Donc, crypto custody, stablecoin issuance, and we are looking further on execution services. Voilà, our ambition is to be a kind of bridge, a regulated bridge between traditional finance and all the crypto world, because we think that the two worlds have a lot to understand from each other, and there was since a long time a strict fence between the two, and we think that in fencing the two worlds is really critical for both worlds to progress, traditional finance to digitalize and have better speed, and all the crypto market to get regulated, increase volumes, and get, let's say, all the professional aspects of what can be a professional market. And we have that experience in the TradFi. Voilà. Donc, happy to be there, and thank you for inviting me.
Thank you, David. And then last but not least, Jens.
Yeah, Jens Siebert, partner with KPMG. Happy to be here today. I'm part of the German KPMG organization, and within our financial services consulting team, I'm in charge of everything related to digital assets and digital market infrastructures. And over the past years have helped leading banks and financial organizations in structuring their digital assets agenda and also roadmap, breaking it down to license applications, and really, bringing together all the components of a digital capital market infrastructure. And before that, a couple of years in fintech space, and also always related to digital assets, tokenization, and crypto. And happy to be here today.
Also very happy to have you. Thank you again, everyone. So today we're here to explore a very timely topic, the regulated layer one or RL1s. And across global financial markets, we're seeing growing momentum towards sector-wide regulated settlement infrastructures. So systems that can support tokenized assets, tokenized deposits, and regulated stablecoins in a compliant, scalable, and interoperable way. So these are not public blockchains, they're not CBDC platforms. We're talking about industry-led, permissioned, institution-grade networks designed to reduce fragmentation, improve settlement workflows, and create a more coherent digital market infrastructure. And just to align on terminology before we start, when we talk about a regulated layer one, we mean this shared base layer infrastructure, so a blockchain or synchronized network operated under regulated governance with institutional requirements around privacy, compliance, and finality. So this sits alongside other infrastructures, public chains, global liquidity, private networks used for internal workflows, and public sector rails being explored by central banks. Today, we'll take a practical approach to RL1s and what problems they should address, where they fit in the evolving ecosystem, and how institutions should think about them now. So with that foundation in place, let's begin with our first segment, why RL1s matter and what is driving an institutional demand now. And I'd like to explore the business rationale here a bit. What pain points, what opportunities, and what market forces are shaping interest in shared regulated infrastructure at the L1 layer. So Georg, let me start with you. Where do you see the most immediate institutional pain points that RL1 style infrastructures can address? And what are banks, asset managers, or market infrastructure struggling with today that requires a coordinated solution?
Yeah, so if you look at how blockchain historically has evolved, right? It started out with these entirely permissionless public open networks where people have done a lot of experimentation and have kind of proven out what's possible using this technology, right? And then because regulated institutions were not able to interact with these types of networks for a variety of reasons, there was sort of the counterpoint to that created, which was the entirely private and permissioned sort of siloed off networks. And I think both tried to solve for different things, right? On the public side, you had the seamless interoperability. You could really see how applications composed on top of each other, and that was a very novel and very innovative thing. But for example, lack of privacy and the lack of control that people would have interacting with such a network has kind of driven the development of the private permission subnets, right? There you can solve for privacy to some extent. There you can solve for the necessary control and governance that you need over your infrastructure, your application. But that came at a very heavy cost, which is that of the interoperability. So you ended up with lots of sort of siloed deployments. And really, where we now see all of those kind of pain points converge or being addressed is sort of the middle ground here, where you can operate an open network that has privacy, that gives you the necessary control over your infrastructure, which were sort of the factors that will really prevent regulated institutions from interacting with open networks, and basically get the best of both worlds. And that's what we've tried to solve for with Canton Network. And I think the fact that we have actually managed to bring not only regulated institutions but also use cases that are heavily regulated into the network have actually proven out that is now possible. So I think in terms of regulated layer ones, it's really there to solve for these requirements that the banks have due to regulation or due to their own internal compliance, which is often a big factor. And once you have the right properties in the mix, then these organizations can start to interact with this technology and unlock the benefits that they get from that.
Thank you. Maybe Jens, from your work with banks and regulators as well, what problem statements are driving interest in sector-wide infrastructure from your point of view? What misconceptions perhaps are there in the market about what RL1s are or are not?
Yeah, I would really say that probably fragmentation of or the being being concerned about fragmentation of digital market infrastructures is really what drives banks and asset managers mostly when it comes to, tokenization cases. Everybody has done their proof of concepts. We know the technology in general works, to issue, trade, and settle all sorts of tokenized financial instruments. However, what we need really is powerful, integrated, and liquid markets that function on a resilient infrastructure. And I think this is really what matters most to banks and regulated market participants. I indeed have the feeling that we are at some point more or less at a tipping point of leaving the POC era behind us and now really working towards joint and powerful digital financial market infrastructures, at least from the European perspective that I mostly have. I can see this development. And you asked for misconceptions. I would really say that we have to make clear that it's regulated financial market infrastructures or joint financial market infrastructures do not necessarily mean that it's a bank blockchain. It's an infrastructure used by a regulated industry to as a technical backbone and foundation to issue, trade, and settle financial instruments, to deploy smart contracts around those types of financial instruments, to have the cash and the asset leg being integrated. But it's not like it's a blockchain dominated by one bank or a small group of banks. And I think also another important misconception is that you really have to differentiate the different layers of a functioning digital market, and I think on those different layers, I can really recommend the ASAP model by the IMF to kind of structure and sort out the digital market infrastructures. And I speed it up here, but the ASAP model, the P stands for platform, or the fundamental transaction network layer in the basement, let's say. And on this level, competition is not really what we need. I think we mostly need collaboration and positive market network effects on this base layer. On all the layers that come on top of that, what kind of assets do we issue and move? What kind of services we provide? How's access managed for clients on the institution and retail side? All of those layers are perfect for competition, the best solution in the market. But when it comes to the base, let's say transaction layer in the basement, the platform, I think collaboration is really key. We also do not need several railway tracks right next to each other. We do need competition of the railway companies on top of it, but a joint set of rails is probably what we and the entire industry is currently looking for.
Yeah. Karen, coming to you, perhaps talking about collaboration at the base layer from your vantage point and also having an international perspective, because Jens mentioned his European point of view. What trends are you perceiving in the ecosystem and developer community that indicate that markets are shifting towards this shared regulated trust layer? What signals are there?
Yeah, I appreciate what Jens said about collaboration, because that's what we're all about as an open source community. And as a sort of neutral convener that brings together people to work and build where there can be shared infrastructure and shared benefit from that. Yeah, I think, building on what Georg said about sort of the evolution here, I think everyone's been doing what they can, especially those who are at the forefront of being on top of new innovations within their constraints. And we've been supporting enterprise institutions in doing that, because like Georg said, there were constraints, regulatory constraints, scalability, privacy constraints in which many organizations just couldn't do and leverage the technology for these use cases with the public and permissionless options. And so we've seen a lot of this experimentation happen within various institutions, both as within internally, or in a small or relatively small consortium. And I think that's been very helpful in order to prepare all these banks, whether they be private or public sector, to prepare them for this next stage that we're in now that the regulatory landscape is catching up and laying down a lot of the possibilities for these things to not be experimentations that are happening parallel to existing infrastructure, but actually start to build production systems, operate production systems that integrate with existing infrastructure. And I feel like that's the place where we are now, where we are seeing institutions really having to now do the very difficult and complicated work of actually really integrating these systems into their very long-standing systems. And so that's both a challenge and an opportunity to bring these new use cases to these institutions. But of course, there's a lot to figure out. Interoperability has been something that our community has been working on for a long time. We have a code project called Hyperledger Cacti and Smoot, which allow for integration between different distributed ledgers. We also see privacy coming up as more and more of a focus, because now we're actually dealing with real transactions, real data. And so there's a lot of different technologies in this space that are being explored, different flavors of zero knowledge. In our community, we have a new project that just graduated called Paladin, which is this composable framework for privacy on EVM. And so I think that we have been creating this foundation of the various tools, and are seeing these networks expand into these multi-stakeholder regulated layer one models, where we need to move towards actually building an infrastructure where we can not only take advantage of digitizing or creating digital assets with this technology, but also the new possibilities that it offers as well. And so I think that's really where you're seeing this evolution into these RL1s, although some have been operating for a while, right? We have DTCC has had their project Ion for several years now, Finality as well, Euroclear. The Japan Securities Clearing Corporation has also had several commodities listed and are doing real transactions with that as well. So this has been happening, but I think what we're seeing right now is, with the shift in the regulatory clarity and frameworks, both in the US and Europe, and the perhaps pressure of competition from stablecoins, we see more of a push into getting these consortia together and creating this infrastructure that can allow us to operate globally.
Yeah, entirely. And I guess that ties in nicely, because I wanted to turn to David now, conscious of your timings as well, since you have to leave us in a bit. Since SG operates also in a hybrid model, you combine public blockchains and regulated stablecoins and tokenized assets. You're not directly part of RL1, but where do you see the RL1 type infrastructures fitting with the broader digital asset ecosystem? And, what problem statements do you hear most often from your market participants?
Ouais, thank you. And sorry, I have to leave at 4:30 sharp. Donc, I will be quick. I think that as a commercial entity of a bank, we have a business approach, and for us, let's say the cut which is between regulated layer ones, whatever it is, whatever we call it, and public blockchains is a matter of goal. I mean, the regulated layer one and the digitalization of financial market is a matter of precisely digitalization. It's a digital transformation process. The banks, the financial markets, the fintechs, etc., are engaged, and they are transforming, but they are, let's say, improving things which exist already. When you put a financial product onto a regulated or private chain, you don't change fundamentally the product. You change the layer which helps you provide better services and deliver better your product and the services which are around. When we speak about public chains, it's a bit different. We are in the process of acquiring new clients, especially for banks, which obviously were engaging relatively, let's say, late in the public the public infrastructures. And here, what we are looking when, as a bank, when issuing stablecoin, is precisely to engage with public blockchains, to engage with crypto markets. And here we are acquiring new clients, because those guys which are trading crypto, Bitcoin, etc., doing decentralized finance, but obviously they are not trading on our infrastructure. They are not buying our products as banks and financial institutions. They are buying products which are decentralized, digitalized for sure, but decentralized. And the question for us is, what type of strategy do we want to follow? And within Société Générale Forge, eh bien, we developed what a bank can do in that industry is providing money on chain, because money on chain is the base layer, the base product for crypto markets to operate. Obviously, stablecoin are absolutely mandatory in this crypto ecosystem. And it is, let's say, the least complex product that a bank can do. A bank, the first product of a bank is providing money to people. But here, it's exactly the same. And that's why, on one hand, we are engaging with some infrastructure for digitalization of capital markets, but that's a long process. It's a medium-term or long-term view that we are pushing here. And that's the meaning of the partnership with Deutsche Börse. Deutsche Börse is in a process of digitalization of their services, especially via blockchain, via D7, etc. Donc we want to be member of that, because we are member of capital market, and we want to reduce our cost. And in the meantime, we are addressing new clients which are crypto today, which probably want to benefit from financial services at a point, because they have a lot of Bitcoin. The value of Bitcoin have grown to a certain level where they need to diversify, etc. And all this need a connection between the two. And the stablecoin, when we analyze the markets, the stablecoin appeared to be, let's say, the easiest way, let's say, to make this bridge and to make communicate two worlds which were not speaking at all. Because the problem that we solve using a regulated layer one is mainly anonymity, KYC, etc. But you don't get new clients. So the fundamental question is, how do you get KYC'd people which are not, or which do not want to be, etc. So that's exactly what we are doing. And I think the split between tokenization and digital transformation, and that's what we did with the US bond on Canton a few weeks ago. But it's digital transformation. New clients, it's going crypto. And sorry, I have to leave you there.
No, thank you.
My
I know
regulator
you
is
have
calling
to
for me.
go. I know you have to go, so thank you so much for sharing your perspectives. I'll be briefly. I'll pick up on your points and I'll try and represent you as much as I can.
Mais voilà,
So thank you for
happy to come
joining.
back and really apologize, but voilà.
No worries. Thank you for
Above
joining.
my head.
Yeah. Have a
Thank
good
you for
meeting.
inviting me,
Thank you.
and bye-bye. Thanks.
Thank you. So we'll continue now with the three of you. And now with David, we've already moved into the segment of interoperability, public chains, stablecoins, public sector rails. So I guess I'll turn back to you, Georg, building on David's perspective to some extent. When you look at institutional workflows like DVP, collateral mobility, all that, what are the biggest hurdles to achieving interoperability in a way that also satisfies regulatory and privacy and operational requirements?
Yeah, I think David touched upon an interesting point, which is really if we're thinking about the layer one base infrastructure, right? It's actually not the infrastructure, the sort of what that runs in the basement that is being regulated, right? What's regulated are applications that run on top of that, right? So I guess it comes down to can this infrastructure provide the right properties so that the regulator is happy for certain, maybe systemically important use cases to run on said infrastructure? And there's a couple of challenges that come with that, right? If we're going back to, let's say, the public chain example, any kind of exposure or dependency on unknown validator nodes would be a non-starter, right? For any FMI or CSD to run their critically important system, if they need to depend on someone else that they don't have control over, they can't fulfill their regulatory function, right? So that's a non-starter. You need to have the necessary control over the application that you run, right? And then the confidentiality of business, obviously very important. Maybe not something that's really driven by regulatory requirements, but definitely driven by business requirements of not exposing the activity to the world. So that comes in. And I think the third aspect around interoperability is obviously critical. I think people have been able to deploy platforms and get some value without the seamless interoperability. But what the technology was fundamentally built to provide is exactly that seamless transacting across different application contexts, right? And the challenge really lies in making all these three things happen, right? There's typically trade-offs to be made that if you want to have all that control, and you might have to give up on privacy or so, and really trying to sort of tick all the boxes that also the regulator wants to see is challenging. I would say though that I would not kind of divide up the world into public and permission and therefore regulatory requirement, right? We have seen, and David mentioned this, and we've done a regulated bond issuance in the US on Canton Network, which is a public network, right? So the public nature doesn't necessarily mean it's non-compliant. It really comes down to the properties of how that network functions and how it can provide certain aspects around it. So I think ultimately we will see different requirements, right? We don't have global, with different regulations globally across the different regions, and every region is slightly different. So I think what's needed is a way to give people the necessary flexibility to deploy this infrastructure, under a certain regulation that might come with certain governance requirements, that might come with certain access requirements. So we need to give people the flexibility to control these aspects while still not giving up on the interoperability aspect. Because if we end up in a world where everybody can deploy their own thing, but when they need to interoperate, they fall back to what we've done for the past 60 years, which is sending messages around and coordinating and reconciling, then we haven't invented anything, right? And then the whole purpose of this new technology kind of falls apart. And I think that's what's becoming more and more clear, that the real value unlock of blockchain technology lies in the interoperation between applications, and that's what it facilitates, and that's where some of that value unlock lies, right? The canonical example that people always bring up is atomic DVP, right? And if you look at what that actually means, it's a coordination or an interoperation between two entirely separate systems that also have to be governed and controlled entirely separate, right? If you take a CSD and a central bank and you want to orchestrate that DVP, that's a challenging problem. And really that's what the technology brings. And unless we sort of hold up these ideals, so to say, or these features that we cannot lose, we're not going to be able to realize the value that comes out of it.
And maybe to just follow up on this, because I think, Georg, you said something really important. It's really not the discussion about public, private, hybrid, whatever. It's about having decentralized network infrastructure that with a clear operating model that addresses the specific needs of the regulated financial industry. And this can be realized in a more public setup. It can be in there are important design decisions to be made, in order to come up with a proper dedicated network infrastructure that works best for the financial service industry. And interoperability indeed is one of the core components of the right design decisions, because I think we all agree it won't be the one network taking it all. There will be some sort of multi-network cross-chain infrastructure in a long-term perspective. But I think this is really the important point. We have to understand that the financial service industry has some specific requirements towards network infrastructure when it comes to really issue, trade, and settle significant volumes over those infrastructures. And that's really the core of the discussion, I think. And maybe to just also coming back to Corinne for 1 second, for example, using open source technology in this setup really can be a very smart design decision, for example, because you also want to avoid that there's a technological lock-in factor for banks and others using your network, and using the network infrastructure. So if you rely on open source technology, there's at least no lock-in effect from a technological point of view. What frameworks are you using, and I think that's really where we have to push the discussion, getting away from this almost emotional public versus private, etc., and really coming down to what are the right design patterns, what are the right design decisions to take on the network level, and then on top of it, you will see prosperous services, volumes, everything rise. It's but that's really, I think we really have to work on the right foundation.
Yeah, I think I saw Karen nodding along as well already. Feel free to take the stage otherwise.
Yeah, I can build on what you said, but if you have
No, I mean, I would rather you build on this, so
Yeah.
just go ahead with that.
I agree a lot with what Georg and Jens said. Because I think one thing we need to really start to move more towards, and what our community is working on, is for regulated layer 1 to function as a sector infrastructure. We need standards. We need common open standards, common data and semantics models. Because yes, like technically we may be able to interoperate, but if we don't have common standards like that, then it makes it very complicated and difficult. And like Georg said, we're just going to set up, like one-to-one setups between different networks, and that's just not taking advantage of the whole point of all this. So I think we see the interoperability as a stack, not as like a feature. In messaging, we have Cacti and Smoot that are emerging as frameworks that provide secure, policy-driven orchestration of multi-step workflows. We also have Trust over IP, which is setting up this portable trust and identity frameworks with verifiable credentials, governance models, so that you can have the various roles, rights, and regulatory entitlements consistently across jurisdictions. And that is also going to be very important for privacy, the way and tokens, we have to define all this, because if everyone has a different definition and way of organizing it, we're not really actually going to be able to make this work. And so a big part of what our community is pushing is more open collaboration on standards. Trust over IP is a standards effort. There are a few token standards efforts out there. There's the ISO 222, there's IETF, but we still have yet to have one or a few emerge in a way that can be leveraged by these RL1s. In the more public space, we definitely have a lot of standards there that have emerged as default standards. But the more that we can bring people together to establish these common data semantics and definitions, the more we're really going to be able to actually have that free flow of data and transactions that we're looking for.
Yeah, and I think you make a really good point where you underline that without like shared definitions, whether for credentials or permissions, token models, interoperability becomes impossible in regulated markets, right? That's what we've been talking about.
Well, it's not impossible. It's possible. It's just
Difficult.
not efficient.
Yes, it's I guess it comes back to Georg's point, right? Where you don't have that, then what exactly are you trying to achieve, right? What's the efficiency? What's the value unlock here? So Georg and Jens, maybe for you two, what does consistency need to look like then in practice? And how do we avoid that every institution or jurisdiction defines these roles differently, like what we just discussed? How do we ensure coherence?
Yeah, can I make a start? I think that the standards discussion is an important one, and we've seen, we've a couple of proof points in the industry. What happens when you agree on a common standard, right? You can take, for example, Swift as one example, or take FPML, or the more recent efforts around CDM, where people really try to define this common language, and then the interoperability comes into play, obviously, because not as Ian said, not everyone will be on the same network. But using that common language, you can at least establish the shared semantics of what a trade is, what a derivative is, these kind of things, and then you could argue it does not matter so much anymore on which underlying infra people run. Because they can essentially exchange information on the business level, and they know the semantics are right. There is obviously an aspect to this where if you can basically not just agree on the data standards, but you can actually encode the semantics into a shared smart contract, then you're really achieving the complete elimination of any discrepancies, because both sides basically agreed that not just the same data goes in, but also the same logic and calculations are happening on the ground. And I think where that's particularly powerful, and that maybe we'll get to that in a bit, is in the context of collateral and derivatives, where banks employ whole teams that are only there to handle sort of dispute management, right? And they get thousands of these every day. And I think it's these types of efficiencies that we're trying to unlock by, ultimately deduplicating things and bringing them onto a shared ledger where people agree on the data model, the standard, and the semantics behind it.
Yes, and before actually, since you already hinted at it, we're going to the use cases and market momentum here. Maybe Jens, for you to add the regulatory and operational standpoint as well. What governance elements are banks and regulators actually looking for in the shared infrastructure? Because we talk about needing the shared infrastructure and wanting coherence, but where might there still be barriers?
Yeah, I mean, to be honest, I have seen more barriers in the past, but I'm optimistic, more optimistic for the future. To be honest, I think what really helps is, I mean, how does a standard arises? The process that leads to a standard is really crucial. We need to use our existing standardization bodies and the governance structure that we have already well established within the financial service industry. We do not have to reinvent everything new, but a standard in order to really help standardizing, to find acceptance. I think we have to acknowledge that the process of how we define it, and also the collaborative approach that leads to a joint language, to a joint understanding of how future digital market infrastructure should look like, is a very important one. I think that's the first point I want to make. And the second one really is, I think, we really have to make sure that, for example, within the World Wide Web, there was also not plenty of good business models arising on the internet, as long as TCP/IP kind of gave it a 7-layer model and some structure, and already mentioned the ASAP model from the IMF. I believe it's a good structure, really acknowledging where is collaboration key and where is competition key, and clearly separating this, because we really want to realize positive network effects on the base network layer. And in order to do so, standardization is the one important point, but the other one is also understanding that this is not a walled garden. Also the access criteria, who can use such a network. It's also the governance beyond the technology that really matters. It must be market neutral. It must be non-discriminating. It cannot be controlled by a small group of market participants. It should have a very good foreseeable governance structure of how decisions are made, and to be honest, there are some good and some really bad examples also in the Web3 space, where you see how token economies are organizing themselves or how they destroy themselves. And do not want to go too far in that direction, but I believe, it's the right tech, it's standardization on tech design decisions, but it's also how do we establish a good and fair governance that goes beyond tech, and that's mostly around non-discriminating access. It's about market neutrality, and it's about clear and transparent governance when it comes to how our decisions made. So it's an exciting topic. It's you really cannot tackle it solely from a tech perspective, but also not from a governance perspective. Things have to come together in order to structure and, as I said, make the right design decisions for regulated network infrastructures.
Yeah. And so you mentioned the TCP/IP. One thing I love about that story is that it wasn't necessarily the only standard or the best standard around at that time, but what made TCP/IP become the standard is that it was open. It was open source, and as a result of that, had built already a network effect once DARPA decided to adopt it. And so it then very, very quickly allowed for, the World Wide Web to flourish as it did. And so, that's something that we really try to push and encourage, is this open development of standards, because there's a couple ways standards develop. They're all fine. We should have various different kinds of efforts and ways of doing this. There's the top down, sort of, you get a group of people together like ISO and have these formal standards bodies. What we host in our community is a little bit more bottom up. It's a little bit more flexible and responsive to what's going on in the market. And then once something starts to become a standard that emerges from a community group, they can then take that and propose it to formal standards bodies. So that's what's happened with Hyperledger Cacti. The people working on Cacti are also at the ETF interoperability working group there. And so we see that as especially in a industry that is very fast moving, where things, if we think about what December 2024 looked like versus where we are now, how much has changed. We do need to have these efforts be very responsive, and to have these things taking place, and the infrastructure for these sorts of networks taking place in with some code neutrality. That's something that we also talk about as well. In the past year, we've had the Hedera code base contributed to LF Decentralized Trust, and also Shielded Technologies as well, contributing part of their code base. That is really a trend we're starting to see, where people recognize that there needs to be a neutrality with the base infrastructure. So that creates an extra layer of open governance, open leadership in terms of how that network is managed, and thus creates more trust for institutions to leverage those networks and build on top of them.
So since we're already talking about building on top of this, and we've talked about the theory, I guess, and what our aim is and everything, let's put it into practice. And also Georg has talked about it before and hinted at it at least. So Georg, from your vantage point, where have you seen, or where are you seeing the clearest path to scale, and where's the institutional pull the strongest?
Yeah, so primarily we see sort of two areas where the path to value realization is fairly short, and those are payments and collateral. Payments, obviously, there's still a lot of friction in today's payment systems, right? For the end client, for the most part, it's always T+1, right? So like now you have stablecoin, now you have on cash, on-chain, sort of cash and cash equivalents that settle instantly. That's an obvious benefit. There's a lot of benefits in cross-border transactions, which take even longer. And it's fairly straightforward to integrate these payment flows, right? So that's the one area where we definitely see value. And from a Canton perspective, we see the privacy as the enabler for the next sort of stage of growth in this segment, because obviously if you move into high value payments, the cash leg of a repo, so that's not something that anybody would put out in the open for everyone to see. The other area of collateral is where we see a lot of movement now. There again, the path to value realization is actually fairly short, because just the fact that you have brought a specific asset on chain gives it the instant settlement capability. And in the context of collateral, that carries immense value, right? To give you a couple of examples, so Broadridge is running a digital repo platform on Canton. They're doing about 6 trillion in volume every month. So that gives you a sense of how this technology can scale if you manage to break into sort of the TradFi type of client base, right? It sort of dwarfs everything that happens in DeFi just by sheer mass that comes with some of these players, right? What we're also now trying to enable is bringing that repo capability kind of in the crossover with some of the more crypto-related use cases. So, for example, our work with the DTCC to bring US Treasuries on chain and allow people to finance them against a stablecoin, right? That solves a whole class of problems during off hours and weekends for people that sort of trade on both sides, right? Crypto and traditional markets, because they have this gap risk that they cannot actually bring liquidity into the system, into the crypto side during off hours or weekends. But the crypto market runs 24/7, right? So that's another problem. And then maybe the third example is where really this collateral mobility translates into tangible value is when it comes to the whole margin management flows that happen, either in a bilateral context or in a cleared context. The fact that people calculate and exchange margin on a daily basis is pretty much determined by the fact that they cannot settle any faster. So what's the point in actually doing it any more frequent? But that sort of daily cycle determines essentially the risk that you're looking at when you have to account for counterparty default with initial margin, right? So on-chain collateral gives you the option now to monitor and manage margin on a continuous basis in real time throughout the day and 24/7 if the market requires you to do so. And that brings really down your risk horizon from 2 or more days to a matter of hours. And that's sort of proportional to the savings that you can extend to people on the margin side, right? That has the potential to massively unlock huge amounts of capital across the globe that people currently lock up for, because they have to basically account for the time it takes to liquidate a certain asset, and that's what's being held in initial margin. And the other related case is obviously that once you get to this asset mobility across the important venues globally, people will be able to basically access that excess collateral that's sitting there idle day by day, and are able to move that sort of in a follow the sun model across the globe and use it where it's actually needed at any given moment. So you can see how just the instant settlement capability on chain unlocks a huge amount of value in the space of collateral, and that's why we were also so focused on that.
Thank you. And I'm just going to open the floor to Karen and Jens and ask you both as well. What do you think are institutions, what are they asking for, and where's the market heading these days, given that it is an emerging topic now? So what do you think is happening right now? Where are we going?
I'll go ahead, I guess. Well, I think what I hear a lot from institutions is understanding privacy and defining privacy. I also think that we are really seeing identity emerge as a key topic within institutions as well. Where there's now an overlap with these sorts of networks and how to leverage or connect with agentic AI. And once you get into that, you can't do that without clear identity definitions and verifiable credentials and things like that. So I see those are two components that I see being explored a lot. Some of this is very cutting edge technology, and so it's things that can demonstrate working in production, but are still new in that. And so I think we'll see a lot more activity with testing these sorts of things and seeing how they work on these networks that are emerging.
Yeah, maybe adding to this maybe a bit more of a European perspective. I think if we look at where's a path to more institutional adoption and also some convergence in the digital asset market, I really have to underline the wholesale trials on distributed ledger technology by the Eurosystem last year. So we had more than 60 institutions from Europe and also global institutions participating in those trials. And then in Q3 2026, we will see a new target service allowing the settlement of tokenized financial instruments in central bank money. So it will be an interoperability solution, but yeah, there was a strong demand by the industry in the trials. There will be, from my point of view, strong demand also in the long-term Pontus solution, as how it's called. And I'm hoping for some convergence also on the network layer around the Pontus solution. This does not mean that Pontus is no chain, no network, right? It's an interoperability solution, but having some market momentum around we can now settle in central bank money, I hope will also push some market momentum on the network layer and on that we go into more integrated market infrastructures in Europe. And second topic I see as in many talks are actually tokenized money market funds and stablecoins, and also the crossover of both, to be honest. And I think especially tokenized money market funds are really one of the most exciting use cases that have a real market value and customer value from day one due to intraday settlement and really providing a secure asset in the crypto space and the cash reserve asset, is definitely something where those bridges between the traditional and also the crypto market, traditional financial market and crypto market is really gaining some very positive momentum.
Yeah, so I think what we can certainly see is that there's not just an isolated development, but that basically everything kind of connects here. So we're talking public, private sector, different types of assets, all the layers, actually not just layer one. Everything kind of comes together here. So thank you actually for shedding a lot of light on this. We don't even have questions, so I guess you did a very good job at explaining it. Thank you, Karen. Thank you, Georg. Thank you, Jens, for participating. Also, a special thanks again to David, who was able to join only for a bit, but nevertheless. So big thank you also to our audience. Thank you all for joining us. We'll be back with more events and discussions and expert sessions in 2026. And in the meantime, you can follow the Digital Euro Association on social media and keep track of current developments through our newsletter. So for now, Merry Christmas, and we hope to see you next time.